Welcome everyone to our Wild Pine San Antonio LLC presentation. It's our latest syndication offering, a new construction build to rent community in San Antonio, Texas. I would say probably the hottest thing out there in real estate right now, these build to rent communities, and I'm just so thrilled to be a part of it in the hottest market in America with a team that we know and love at Real Wealth that we've been working with and our investors rave about. We're just really stoked on this project and happy that you're here. If this is your first time, welcome. If it's not your first time, you're going to hear some repeat information, but sometimes you just need to hear it a few times to have it sink in. We just have had, I think there was something about the election that had people, most investors don't like uncertainty. And then after the election, wow, we've had a lot of investors diving into this project. I took Thanksgiving off and came back to find out we've had quite a response. So that just seems to be how elections go. So if you're interested in this, you definitely want to get your documents in order because it is filling up. There's been a lot of interest. I'm Kathy Fedke, co-founder of Real Wealth, and again, so happy to have you here. Welcome. Get to the next screen. Okay, so this is our disclaimer, and my goodness, it's a long one. I'm going to leave it here for you to read, and then you can also read it in the recording, which we'll be sending to you. Because if I read it to you now, you're just going to go to sleep. I don't want you to do that. Okay, not yet. But the main thing to understand is that with any business plan, with any syndication, you are projecting, anything can happen. God help us. We don't need another pandemic. I don't think we'll have one, but these are basically projections and forecasts. We are very conservative in the underwriting because I've been around long enough to know that things do happen and it doesn't go to plan. So you have to be uber conservative. And I'm so happy that Paul DiVincenzo is now our syndication manager at Real Wealth, and part of the process of onboarding him or even choosing him out of several thousand applicants was that I threw out a deal that I knew probably wasn't going to work, and a bunch of people tried to make it work in their underwriting, and he came back with pages and pages as to why it wasn't going to work, and I thought, this is the guy. That's the kind of underwriting we need here. So with this project, let me just go over the investment highlights. It's at 28 duplexes, so it's a small community, 56 units, a great way to sort of get your feet wet and build to rent, because this isn't, massive. This is like, think of it like a 56 unit apartment. It's pretty small, very manageable in San Antonio. And as we're going to hear a little bit later, this is one of the top 10 fastest growing zip codes in the country. So really well situated, really high-end neighborhood. The homes next door are above the median home price of the area. Beautiful area. And these will be built and managed by an experienced property team. This is not their first, deal. They do lots of these. We're just happy to be able to partner with them. We're offering an annual 12% preferred return. That means out of profits, investors first get their capital, then they get their 12% per year, and then we split. That's when our team and the builder, we all get our money, after the investors have gotten their 12%. Then we split 50-50 pro rata. 100% of available cash goes to investors until they receive their capital, as I said, and then their preferred return. We expect this to be about a 5 to 6 year project with a sale in year 5 or 6, depending on the kind of offers that we see out there, what the market's like. We have to be a little bit flexible on that day. We don't know where the world's going to be in 5 years. We obviously have projected that we think this part of the world is going to continue to grow. But that's the plan. Get them built, stabilized, and then sell them for a nice profit. As I said, very, very conservative underwriting with strong returns, even so. Minimum investment requirement of $50,000, and it's a 506C, meaning that we can talk about it publicly, but only accredited investors can invest. again, I'm Kathy Fetke. I'm the co-founder and CEO of Real Wealth and Real Wealth Developments. I've been investing for, I have to change that to almost 30 years. And our network is over 75,000 people. I also, of course, host the Real Wealth Show, the Real Estate News for Investors podcast. I'm on Bigger Pockets on the Market, author of Retire Rich with Rentals, and also our newest book, Scaling Smart. I have been a frequent guest on all kinds of media, and I'm very proud to say that last week when I took the week off, CNN called and my hubby filled in for me. I did a little coaching, gonna be, honest here. I coached him a little through it, but he did great. He was wonderful. Right. This was a very cool thing. I was named among the top 100 most intriguing entrepreneurs by Goldman Sachs. In 2012 and 2013, I was there with the founders of Uber. Elon Musk was there. People didn't even know what Uber was at the time, but it's really big names. And I was chosen in the real estate world because of our work helping to kind of turn around America. And these neighborhoods that had gone into foreclosure, we were bringing investors in, buying up the neighborhoods, fixing the houses back up into very nice condition and restoring neighborhoods. So that's how we won that award. All right, so with that, I would like to invite Clay Schlinke, owner and CEO of Invest5S. We just love these guys. They have been a big part of Real Wealth for the last few years. Apparently we met a long time ago, but wish we'd, kind of started working together sooner because they've been building duplexes, fourplexes. Our investors at Real Wealth have been buying these. But that's when I said, Paul, let's talk to Clay about doing a syndication where instead of people having to put several hundred, maybe even, several $100,000 down to buy a duplex or fourplex, how about just 50,000 and we'll syndicate. So Clay, I'll just kind of hand it to you from here.
Sounds good, Kathy. Good evening, and thanks for having me. And yeah, we met a long time ago, to be honest, and you just started doing business together a few years ago, but it's been a great few years and looking forward to a very long future working with Real Wealth. So we're excited about being part with you on being partners on this project. So a little bit about myself. I've been in real estate since 1994, in San Antonio since 1994. Got started flipping houses, was flipping about 120 homes a year, and then in 1999 we started building, and now we do land development and construction, and really our sole focus is duplexes and fourplexes in San Antonio and in Dallas Fort Worth as well. And so we do the land development, we do the building, so it really helps us be able to control our costs. Like I said, I've been in the business a long time. My wife's, the picture there is with myself with my wife, and she owns and operates a property management company that manages everything that we build. And currently we're building about 500 units a year. I think next year we'll probably be closer to 750. Might get to 1,000. That's our goal. We'll see. It's a big jump, but we're excited about the future. So San Antonio, why San Antonio? So I've been in San Antonio since 1994, as I said, and I've seen the growth. I mean, it's tremendous. The city is a fabulous city. If you haven't been here, you definitely need to come see. It's a very, like the slide says, vibrant, culture-rich history. I mean, it's a very old city, but it's a very beautiful city with a lot of history and charm. Population is booming. So we are growing tremendously right now. We've got a lot of job growth, and our housing is very affordable compared to, of course, the rest of the United States, but even Texas. So we're kind of a more affordable market than, Austin, Dallas, Fort Worth. And being in Texas, we have very favorable landlord-tenant laws, which is great. And then, of course, with the growth we are having strong rental demand in the San Antonio market. Yep. Okay, here we go. So this is just a little facts and just some information that you can get, if you Google San Antonio and look at the growth. So ranked one of the fastest growing cities in May of 2024. So San Antonio actually was the #1 city last year for people moving from the United States to a certain city. So I guess domestic migration. was the #1 location where more people moved to San Antonio than any other city in the United States. Our unemployment rate is very low, second lowest in all the metro areas in the state. And right now, occupancy rate 91.2. We do have tremendous growth. We're expecting to double in population by 2040. So we do have a lot of people moving here. So units are filling up, and in our projections, we'll kind of, Paul will discuss that in a little bit, but we feel like our projections are very conservative on how we'll fill up this complex. This is just we just had the San Antonio tour. So there's a few pictures from when we had the Real Wealth. Actually, Real Wealth had y'all's, was it annual? I guess your annual kind of getaway?
We had our annual retreat. We wanted to bring the whole team to see our #1 most popular market and to show the site. So, the duplexes we're looking at there are an example of, some of the ones you've built. And then the picture in the middle is the land for this project. And you could see the group that came. It was really a great time, and our team just loved San Antonio. We stayed on the Riverwalk. There was so much to do. It's such a cool city.
Yeah, it was a great tour. We had a great time.
Karaoke one night.
Yeah, it was exciting. It was a nice time. But yep, so that was just kind of showing that slide just kind of showed the pictures of, on the left is kind of a single car garage product we build. At this project, we're actually going to do a 2-car garage product, which is where all the people are standing in front of. That's one of our 2-car plans, single story, and then we have a 2-story 2-car garage plan as well that we'll build at the Wild Pine site.
So with the business plan, we'll bring in Paul to go over that.
Yeah, thanks, Kathy. Hi, everyone. So I'll run through our overall this high-level business plan. Invest by Invest has acquired the 9.6 acres of commercial multifamily approved land. Once we do hit the minimum funding, that will be transferred into the Wild Pine San Antonio name. And then once we hit the maximum funding and the land is closed and transferred and construction finance in place, we could then begin construction. And we do have already non-binding construction term sheets in place for the construction loan. So as we mentioned, the plan is to build 56 units, 28 duplex over 36 to 40 months. That timeline has been given some additional time. I believe Clay said originally like 28 months would be the goal, but playing very conservative, we added some additional months in case something out of our control occurs. So the first phase would be all site plan, second phase of 14 duplexes, and then the third phase is another set of 14 duplexes. While the first set of, or after finishing the first set of duplexes and we start on the second set of duplexes, we'll be pre-leasing, leasing and pre-leasing the duplexes. So we plan to finish everything, the construction and the leasing by month 40 that we have in our pro forma. We estimate the leasing rate to be at $1.52 per square foot, which comes out to $2,099 per month, which is in line with comps in the market for 3 bedrooms, which is $1.49 to $1.79 per square foot.
Okay.
Once the construction is completed and the leasing portion is completed, we have to take the construction loan and convert that to a permanent loan. So we'll go out to our network, probably will go, since we know we're going to sell the property in a year or two, probably we'll go to a Freddie and Fannie loan and take out a 30-year loan with some additional interest only, which will help our returns while the LLC owns the property still. So we will hold the property for 5 to 6 years. And then our exit strategy is to sell the property, one, either as a bulk portfolio with an exit cap rate around 5.15, or we could sell them off each duplex individually, one at a time. So it gives us 2 different ways to exit it. Obviously, when it comes to that time, we could look at what is the best scenario and what will bring the most price for the property, either a bulk sale or to sell them off individually.
Yeah, the property I'll jump in here. Is 9.6 acres. As Paul mentioned, we've already bought the property and started already diving kind of into the engineering to get a head start on the project. It's located in the northwest market of San Antonio. So it's kind of off of Loop 1604. So San Antonio has two loops, 1604 and Loop 410. So you can see on the map in the top right corner, northwest, it's close to UTSA, which is the University of Texas San Antonio, about 40,000 students. It's close to USAA, close to the Texas Medical Center, shopping, the big kind of outlet, the mall that's called La Cantera is there. So everything's within about a 10-minute drive to that site, those locations that I just mentioned. And then really adjacent to it is tons of shopping, tons of restaurants. So just a fantastic location and super close to Loop 1604. So you can go anywhere in San Antonio within about a 20-minute drive. So even if they work downtown, it's about a 20-minute drive. If they work at Lackland Air Force Base, it's about a 15-minute drive. So, as the slide says, location, location, location. This is one of the fastest growing zip codes in the United States, and just tremendous amount of growth currently at this property. Here's a picture of it. So you can see there's, to the left is the single family neighborhood, which Kathy had mentioned earlier. And then right above it, there's an apartment complex. I think we have actually there's two apartment complexes. So our rents are going to be very, very competitive with these apartment complexes. So we normally try to develop and build adjacent to apartment complexes just because it's very easy for us to convert those tenants and then convert their prospects when they come into an apartment complex to look and they see our product and they realize they can get a townhome basically unit that's the same rent price as the apartment, but they get a yard and they get a garage. They don't have a neighbor above them or below them. So it's very easy. It's easy for us to rent when we're adjacent to apartment complexes, and we really try to identify sites that give us that advantage. And then I think there might be another picture. Yep. So then that's kind of looking south, and you can see there's another apartment complex, a couple of apartments there. And then to the left, you'll see commercial. So Loop 1604 is really right there, kind of in the top left. You can see it barely, but we're that close. I mean, we're a block off of Loop 1604, and all of that is commercial. So you've got, restaurants and stores and, movie theaters, and anything you could want to do is all in that area. Product type. So this is a product that we're building currently at another location, which we sold out really quick. So it's a 3-bedroom, 2.5 bath, 2-car garage. Each unit has their own private backyard. Everything's included, so it's 100% rent ready. So we include stainless steel appliances, granite countertops in the kitchen and bath. We might do quartz countertops. We're kind of going between both of those to see what we'll end up doing, but it'll be a real nice countertop when we end up putting in. We do a technology package, which includes a keyless door entry and a smart thermostat. And then, everything's engineered. Like I said, it's 100% rent ready. So includes mini blinds, includes a garage door openers, fully landscaped front and backyard. So as soon as we're finished, we can start moving tenants in literally the next day. Construction breakdown. So this is just a little talking about my company and what gives us, we feel like, a competitive advantage. So we've been building for a long time, 20 plus years, and we build a very specific product, and we build, we have very minimal number of plans. So we know to the penny what these duplexes will cost us. We know exactly, all the materials. We have the contractors, they work just for us. So we have a really large team, and that gives us the advantage to really push our price point down on construction costs, which in turn is going to end up translating into more profit for us on this project. And these kind of bullet points talk to that, but being a production builder, we can buy in bulk. We get a lot of savings by doing that. Our subcontractors have been working with us, some of them for over 20 years. And one thing that we do different as well than a lot of builders, we, if they finish the work by Wednesday, we pay them on Friday. So that gives us a huge advantage as well, and really just helps keep our costs down, which, like I said, is going to translate to more profits for everyone in this project.
Okay, so the offering details, this is, as I said earlier, this is accredited investors only because of the way we filed as a 506C. This also means that you need third-party verification that you are accredited. That would be from your CPA or a financial planner. You can talk to our team to find out the definition of accredited. We have Class A members are US, Class A2, non-US. So we do accept foreign investment. IRA investors also are accepted, and minimum investment is $50,000. The minimum funding deadline is December 15th, and then after that, January 31st. So conservative, as I said, conservative underwriting. Again, I'll hand this over to Paul as he did it.
Yeah, we began sort of a lot of questions just regarding the underwriting. So this threw some high-level bullet points in here to go over. The total project cost is around that 12.5 million. As Clay just pointed out, we are using numbers from his current project, so that it's not really estimates. So we feel very confident on the numbers he provided. However, we still put in soft costs, hard costs, and financing contingencies in place to just in case something would occur. And then also with the timing, we have interest reserves for up to 40 months. Again, I know Clay mentioned that it might be as soon as 28 months that we could be done with construction. So those numbers are built into the pro forma right now, which obviously affects returns. But if we don't need those contingencies and if we get it done faster that we anticipate, those numbers will be coming down. But we wanted to play conservative just in case something could occur that's outside of our control. Same thing when we did the budget for the operating expenses. We have additional increased costs added into the operating expenses, even though the first year it is under a builder warranty. We also have operating reserves in place, and then we have additional payroll for potential third-party vendors if for some reason we would have to bring one in if something would occur, or for additional management needs if necessary. So again, just adding some additional costs to play it very conservative. And then in the lease, for the leasing, same scenario. San Antonio normally sees that like 3 to 4% year-over-year increases in rent. We kept it at an annual lease rate increase of 1%, which is below market. The expenses increasing, we have at 2% per year. A lot of syndicators or developers, if the expenses are increasing 2% plus a year, they have the lease rate going up above that 2 or 3%. So we sort of did it the opposite way, just to again play it more on the safe side. We have concessions in place. If we have to give free rent, that's built in. We have bad debt reserve if someone doesn't defaults on their lease. We have a fund for that, and then we have a 5% vacancy in place. So again, sort of beating this down a little bit, but I think it's very important to understand sort of how conservative the underwriting approach that we took to this deal is.
Absolutely. Whoops, did it want to skip again? Yep, there we go.
And this the financing assumptions, as mentioned in the business summary. We have to take out a construction loan first. We do have a term sheet in place. Again, for the pro forma, we put in a 9.25 interest rate, LTV of 71.2%, 36 months construction loan. But right off the bat, our interest rate is below that 9.25. The LTV is higher, which will reduce the amount of equity we need for the project. That will just increase returns right off the bat. Refinancing is based off today's standards, so we didn't go out in 5 years and say, hope interest rates go down. We did the underwriting based off, conservative underwriting based off today's standards. So this is how we sort of calculated the financing in, 3.5 years from now. On the sale exit, same thing. We use today's sort of data and market history of what occurred and comps, and on in a sale in year 5 or 6 is the plan. If we do it off a cap rate, it would be around 18.2 million number. And then if you actually break it down, if we sell them off individually, that is 325,000. But San Antonio has seen year-over-year appreciation, and as of today, December, Clay's team actually is already selling these for 300 to 325,000 range per unit. So again, we really haven't factored in that appreciation into the deal, keeping it conservative, just underwriting it to sort of today's standards. So the highlights. The first overall projections deal with the sponsors and the investors, IRR and returns. Below it, we broke it out just to show the investors' returns. So very strong returns, good IRR, 16.12. The equity multiplier you'll see in the chart next to it shows basically almost a 2 equity multiplier. If you gave 50,000, preferred return of 23,000, your profit share 50% would be around 24,000, so 97,000 total distributions, obviously minus your contribution of the 50,000 that you gave, so almost doubling your money in that sort of 5 to 6 year window, and overall good ROI, and then your profits that the investors will share would be around that $3.4 million. And that is 50% the entire time. There's no waterfall structure. Sometimes in syndication deals, you'll see a waterfall structure where it starts higher, but then your profit gets reduced. So it might start at 50%, but profits in the end get reduced down to whatever, 20, 30%. This stays at 50% the entire time.
Okay, so distributions, as I said earlier, there's the Class A members. That's the investors. They receive their adjusted capital contribution first from the money that comes in, pro rata until all capital has been returned. And then the next cash flow goes towards that 12% preferred return, which is annual. So it's not just 12% total, it's per year. So until investors get their capital and then the 12% per year, then we split the remaining profits between us and the investors. Risks, there's always risks, and very important to know that with any real estate investment. There's, gosh, I don't think this was ever on our list before, but worldwide pandemic, real estate risk, values going down. We don't really see that happening too much given the shortage of homes in America, especially in these fast growing markets, but it's always there. Build to rent risk, if we can't get it done, but our partner has done so many of these, I don't see that as an issue. Operating risk, securities risk, special risk of the company form and membership units. I'm not even sure what that means, but I guess it's a risk. Tax risk, and then you can see the rest of the risk factors in the PPM. So how to invest. Ann Triplett or Kathy McBride have been working with Real Wealth for many, many years, helping investors understand how to fill out the paperwork, because it is very different than just buying a home. If you haven't done a syndication, there's a lot to go through. You can get those documents at realwealth.com/wildpine. You'll see the offering documents there. You'll see a private placement memorandum, which describes everything we just said. And then also the operating agreement. That's also what we said, where, voting rights and how the money is distributed and so forth. It's outlined in that. You can send your questions to paul@realwealth.com. He's been really great at setting up those appointments and answering individual questions. And again, if you have questions on the paperwork side, reach out to Ann and Kathy at syndications at Real Wealth. You would follow instructions on the investor portal for submitting the document. It's all there on the portal. Third-party verification, as I said, will be needed. You can go to verifyinvestor.com to get that, or your CPA or a financial advisor. And then, of course, as I said, space is limited. We've had quite a lot of activity just the past week, so we're kind of seeing that. I actually just did a podcast on that today on how now that uncertainty's kind of gone and people are thinking that there's either going to be inflation or growth or, you know, a different trajectory, that there's a lot of investment happening. So space, again, is limited, first come, first served, based on ability to fund and provide accreditation verification. So let's see what questions we've got. I'm going to head over here. And has the project met the minimum? We have met the minimum. We're just waiting on some funds to hit the bank. How do you identify San Antonio and not Houston or DFW? We love those markets too. Well, I'm not a huge fan of Houston, not for any reason other than the taxes seem to be pretty high and the storms and so forth. But we love DFW.
Yeah, I was going to jump in.
You do too, right? You're building in DFW too.
Yeah, I love DFW. It's a market we're going to really expand a lot in. We've looked at Houston quite intently. You know, we've really looked at Houston. I mean, it's something we might be in Houston at some point, but the reason we haven't been is just the insurance is higher, being on the coast, and you've got, you know, more wind, you've got hurricanes, you've got flooding,
all those things. Yep.
Yeah, one reason we haven't really gone into Houston.
And crime, there's areas with crime I just not interested in. I mean, obviously every city has it, but gotta be careful in Houston. Yeah,
San Antonio and DFW are very, you know, I feel like, you know, Austin is Austin. You know, Austin's very high tech. San Antonio and DFW, I think, are very well-rounded cities. They're very, you know, diverse cities in their workforce, and which kind of gives it a little more conservative nature for, you know, just stability. I think you'll see that in your appreciation rates. They're just more stable and more steady, which was what we really like.
Yeah, and on the other side of our business, the Real Wealth Realty, where investors just buy the properties outright, they don't do it through syndication. Dallas and San Antonio have been our most popular markets, so they're both great. We love them both.
Mm-hmm.
If you opt to sell the properties individually, will your investors have the first right of refusal to purchase? That's a good question. You know, in any kind of project where we have investors involved, you know, there's conflicts of interest, right? We can't give an investor a deal because then that cuts the profits of all the other investors. So certainly an investor could buy one of these properties, but it would have to be at market rate. There wouldn't be any discounts. Can you speak to absorption rates of similar housing in the market? And I assume absorption rates would be on the rental side.
Yeah, we had one of the bullet points on the Why San Antonio slides around the numbers, but this year they're estimating about 12,000 units being delivered, and the absorption rates are at like 14,000. So the demand for apartments is still outpacing how much is being built, which is a very good sign. And actually only 10% of the units being built were 3-bedroom units. I believe a lot of the units are 1 bedrooms more north where the University of Texas San Antonio campus is. So more less competition for the 3-bedroom units in this market as well. I don't know if Clay, if you have anything else.
Yeah, no, you're right. I mean, that's exactly right. A lot of 1-bedroom, 2 bedrooms being built, not as many 3 bedrooms as you mentioned. In this location that we're at, the nice thing about it is it's really a mature market. So it's really built out. This is kind of the last piece in that area. So we've got apartments there that are already built and you know, occupied and filled. So it's not something where we're going to be competing with a lot of other units that are trying to first time lease up. So I think that's going to help us out on this location immensely.
Expected IRR. Want to go over that again, Paul?
Yeah, so the IRR is it's 16.12, but I guess just so you understand, the IRR gives you sort of the rate of return, but over the entire length of the project. So it's a very strong indicator. It takes in the time value of money into equations where maybe like the ROI doesn't. So this sort of, which is why it's a little higher, but it sort of takes in, you need an end date, obviously a start and an end date, and it calculates sort of your total return on the investment. So, we try to target in that range, which is obviously very strong return.
Okay, well, that's it on the questions. So thank you guys, and thank you all. If you have more questions, you know that you can send them to paul@realwealth.com or set up an appointment. And if you have questions on the paperwork or how to submit the subscription agreement and so forth, just reach out to syndications@realwealth.com. Thanks, everybody. Have a wonderful evening. I hope you had a great Thanksgiving, and we look forward to seeing you or hearing from you soon. Take care.